if you're co-investing as an LP in private equity or a venture capital fund, you can really get to pick and choose what investment you want to do that with. So you've made an investment in the fund, and then that fund is obviously going out and investing in portfolio companies. And sometimes what happens is the amount of money that that company actually needs is more than what the fund can do allocation-wise because of their roles and governance. So the investors will invest with them. And, I've seen in certain circumstances where people have actually increased their returns by 2 to 3 times by doing that because they like that one industry. But you really need to understand what that is. You shouldn't do it for all of the investments. You should be very, selective on that. Usually the secondaries mean somebody needs liquidity. So therefore, there's going to be a fairly good sized discount. The question is then if they need to get out because they don't feel that they're going to be getting their cash anytime soon from the funds, I believe you need to add on several years for what they actually think in calculating what return you're really going to get. I've seen situations where that's worked fairly well, and I've seen situations where the assets that were the private equity firm had decreased in value, and the value just wasn't there at the end of the day. So there's a risk on timing, and there's a risk on the underlying asset. And that's one of the reasons why, the discounts on the secondaries are so high. You have to know who the jockey who's running those funds, and do they have the right reputational risk that they're going to make sure that those funds are going to dispose of those assets in an orderly fashion where you're going to get some, rate of return on there.